In this week's video, we're going to be taking a look at why I believe the UK house price crash is far from over. Now, you may have seen some articles over the past few weeks talking about how mortgage rates are coming down and how sales activity is picking up in the housing market and that everything is going to be absolutely fine. Well, I don't think that's the case, and that's what we're going to be taking a look at in this video. So in front of me, we've got the latest HPI from Rightmove. This has just been released this morning. So I just want to go over this very quickly before I get to the other points that I want to make in this video. So firstly, let me just blow up a line of text which sums up what has happened. So new seller asking prices rise by just 0.2% this month, which is notably lower than the average increase of 1.2% for this time of year. So there are two things to take away from this. Number one, remember this is new seller asking prices. This does not include the listings that are currently seeing reductions on Rightmove. And number two, despite the fact that house prices or asking prices, remember, are up 0.2%, this is much lower than they would expect, which was 1.2%, which is the average. So the so-called spring bounce isn't being reflected in this data. So that's the first piece of information from here, and just a couple of other bits that I thought were interesting for you guys to be aware of. So despite the economic headwinds, first-time buyer type properties hit a new record price. Faced with record rents, buying is still compelling for those first-time buyers who are able to clear the mortgage and deposit hurdles. So that's something to keep in mind as we go through this crash. Rent prices are still crazy high, which will be encouraging first-time buyers that don't want to get stuck in a rental situation to maybe take on mortgages they maybe don't want to take on because it's still preferential to going into rented properties that have got sky-high rents at the moment. And this is reflected in the sales volume data. The first-time buyer sector, which is 2 bedrooms and fewer, leads the recovery with agreed sales now 4% higher than in March 2019, while second stepper sector remains 4% behind and top of the ladder sector 3% behind. So that shows that the first-time buyers are underpinning the market at the moment. They are almost moving out of desperation because the rental market is so bad, whereas sales volume for second steppers and top of ladder are still behind 2019 levels, which wasn't actually a great year for house moving. Anyway, house prices in 2019 didn't do an awful lot. So I just wanted to get that over to you guys, and also seeing this visualized. So from Built Place, they've taken that data and put it into this lovely chart. So the Rightmove or the Rightmove house asking prices, remember this is not agreed sales, this is asking prices. You can see they are heading down. So while month on month they might be up 0.2%, they are definitely heading down on an annual basis, and this is coming down quite steeply. And the blue line here is nationwide, so these are agreed sales based on nationwide mortgages. They are both heading in the same direction. And what this crossover shows here is that the agreed sales from nationwide are declining on an annual basis faster than Rightmove asking prices, which shows that sellers aren't yet catching up with the reality of the housing market. So it'll be interesting to see this. I would expect to go negative over the next few months. Rightmove will start to go negative month on month as well. So that is just what I wanted to look at with Rightmove. Now let's get into some of the other data. And this is my favorite chart of all the stuff I've shown you guys over the past few months. This little bit here, this is what's got me excited. I talked about this a few months ago, this top-in pattern. This is the ONS figures, and for the third month on the trot, they are showing a monthly decline. So I think once you see 3 pieces of data, that starts to form a pattern. Just 1 or 2 pieces isn't enough, but 3 pieces is the first sign that a pattern is forming. And look how similar this top-in pattern looks to back in 2007. It looks very, very similar. And you can see this little peak here, what I call the denial peak. We could quite possibly see one of those as well, which would marry up with some of the more positive data that we've seen from Halifax over the past couple of months. So if that does play out, I wouldn't panic. It's just, I think, going to be what's happening here. And then we're going to start getting into the real drops as reality hits home with sellers and we start to see real panic in the market. So yeah, this here, despite the fact the data for the ONS lags so much, seeing this form, this top-in formation with 3 months back-to-back heading down is a very, very strong indicator that this is heading in one direction over the next few months and potentially longer. So that's the first thing, the ONS data. The next thing is inflation. We've been told for the past few months that inflation is coming down, inflation is under control, inflation is just going to magically go away. we're in March 2023. We're in April 2023. This data is from March 2023. Inflation is still in double figures at 10.1%. Now, I do expect inflation is going to come down over the next few months, but I don't think we're going to go back down to this 2% level, which the government seem to think is magically going to happen. And then they're going to say it's all down to them, despite the fact they're doing absolutely nothing to fix inflation. It's just going to happen as the markets correct themselves. So inflation is still crazy high. And when you put this into context with wages, so inflation at 10.1%, and that's just official figures. I'm sure many of you guys will probably agree that in the real world, inflation feels much higher than 10.1%. Private sector pay is up 6.9%, so people in the private sector are getting poorer by 3.2% per year, and public sector pay up on average 5.3%, so everyone in the public sector is on average 4.8% poorer. So inflation is still a big problem. Now, we may see the point later on this year where prices do come down and private and public sector pay maybe cross over, and then the cost of living starts to improve. But at the moment, we're still quite a few months away from that happening. So inflation is still a big problem. And the people that are in work, this is going to be a problem as well, because let me blow this up for you guys. The number of people looking for work has risen as job vacancies fall, suggesting that the uncertain economic outlook is hitting employment. So I've talked about this in previous videos. When things like interest rates are hiked, it doesn't have an immediate effect. It has a lagging effect on the economy. So it may still be a few months before we start to really feel the pain from the interest rate hikes that have taken place over the past year or so. About 220,000 more people were seeking work between December and February than in the 3 months before. And if we scroll down to the chart, you can see here vacancies are coming down. Now, there still are a lot of vacancies out there, so you can't take that away. But you have to question, one, the quality of the jobs that are available, and two, the direction of this is very, very clear. The number of vacancies is coming down. And also, the actual number of people employed, I haven't got a graph of this, the number of people employed, so unemployment and employment are actually separate things. So the number of people unemployed can go down, whilst the number of people being employed doesn't necessarily have to go up, because what the government has been doing has been classifying some people that are unemployed as either retired people, as carers, as long-term ill. So we are still below the levels of employment since pre-COVID. And I think that's reflected in the GDP figures, which went sideways at 0%. And this was celebrated as good news that we've avoided a recession, or we're currently avoiding a recession as we've got 0% GDP rather than negative GDP. But what is actually the point of having an economy that isn't in recession when people are getting poorer? It means the GDP figure is basically pointless other than for headlines and for market sentiment, I guess. But there's little point in the country being at 0% GDP or even in growth if people are getting poorer because inflation is outstripping their pay. And just going back to the point I made at the start of the video, that people talking about mortgages coming down basically is evidence that the housing market's going to be absolutely fine. Yes, mortgage rates are coming down from the peaks that we saw at the end of 2022. And you can see here, each colour represents a different loan to value. But historically, compared to what we've had over the past decade, but more so over the past 5 years, they are still a lot higher. So yes, they are coming down, but are they really coming down enough to sustain the current house prices? I do not think so. The other thing to keep in mind as well, despite the fact mortgage rates are coming down, so far very few people in the context of the overall market have been impacted by the higher mortgage rates. And if we go through to another chart here from BuiltPlace, which by the way is a fantastic website, so make sure you check out builtplace.com. You can see here, and I've covered this in the past, this is the number of people remortgaging every quarter. So if we look at 2023 quarter two, we can see we've got about 430,000 people remortgaging this quarter, and over 300,000 of those are remortgaging from an initial fixed rate of 2.5% or less. And if we go back to the current offers here, if we take an average loan to value of around 85%, the average 85% LTV mortgage at the moment is pretty close to 5%. So I think it's fair to say that everyone remortgaging at the moment, also not everyone, 300,000 people, so over 100,000 people per month are remortgaging onto an interest rate that is at least double what they've been paying for the past few years. So yes, mortgage rates may be coming down, or they may have come down. I'm going to come back to that in a moment. But the real pain is still yet to be felt by so many people, because so many people are yet to feel their actual own mortgage go up, their own interest rates go up. And just going back to what I was just saying, these are the 5-year swap rates. So there was a lot of talk, and I even made a video about this a few weeks ago when the banking crisis kicked off, and I was talking about how interest rates may not be going as high as we expected. But the banking crisis seems to have calmed down, and swap rates have gone back up. And a lot of this was in response to the inflation data that I just showed you. The market's expecting inflation is going to be a bit more sticky, so the Bank of England is going to have to go even higher with the interest rate. So we can see here swap rates are well above 4% at the moment. And swap rates are important, as that is basically the rate at which lenders lend to each other before they lend to you. And I've talked about this historical trend line over the past year or so. Let me see if I can just adjust this data so you guys can see. And this is the trend line that I'm talking about, this upward trend that started back in, well, I guess summer 2021. Swap rates have been heading up ever since. We saw this big spike with all the mini budget fallout, and then everyone thought everything was going to be okay, and then inflation data come in high again, so it shot back up. Then we had the banking crisis, so swaps started to come down, and now the banking crisis has cooled down, and this upward trend has been maintained. So it's going to be very, very interesting to see where this actually ends up long term, because all the time this is above 4%. It's going to be very, very hard for lenders to lend below 4%, and if it goes even higher, if the Bank of England hike again, I would expect this to go up. And if we look at all of that data together, so we've got inflation still in double figures at 10.1%, employment up, job vacancies down, real world wages down, GDP sideways, swaps up, and the ONS house prices fall for a third consecutive month. I think we can have confidence in the fact that this house price crash is far from over. So if you're not subscribed to me on Twitter, make sure you follow me at Darren the Degen. If you found this video helpful, I'd appreciate you scroll down and hit that like button. If you want to see more from me, subscribe to the channel. And if you want to see the one big thing that I've been wrong about so far with this house price crash, I'm going to pop up a video in front of me now, and I'll see you guys over there.